Much of our understanding of monetary policy and money supply is about to change. You thought that a bank can give loans only to the extent it has deposits? Wrong. We thought that if a central bank keeps excess cash reserves, liquidity in the banking system, more loans can be given? Wrong again. Says who? A new book. It's called Money, a Zero-Sum Game, authored by KV Subramanian, that's India's former chief economic advisor, and his colleague KV Vaidyanathan, another bright young economist. The book has hit the stands and it is about to challenge many mistaken notions and theories in monetary economics. Well, with this intro, let me welcome the author himself to explain the theories in his book. Joining me is Dr. Krishnamurthy Subramanian, one of the authors of the book. Dr. Subramanian, thank you very much indeed for joining us. Well, first up, why have you written this book now? Are you seeing too much of wrong policies?
First of all, thanks a lot, Lata, for providing me the opportunity to talk about the book. Back, during the financial crisis, since then, my co-author and I, we've been observing central banks across the world pull out many unconventional techniques to try and stimulate the economy, to increase bank lending, increase growth. What we've observed is that many of these so-called bazookas that central banks across the world have pulled out have actually turned out to be damn squibs. Even during COVID, again, central banks across the world tried to do more of the same. So when we, started thinking about why is it the case that a lot of these measures that central banks have attempted, and if you notice, many of their balance sheets have multiplied, many times over, yes. And yet, they've not stimulated the economy. So we started thinking deeply about this, and what we found is that the monetary theory that draws, that guides policy, monetary policy itself is flawed. And that is why we are writing this book, one, to point out the flaws in the monetary theory, and second, to provide a new framework that is practical enough to work.
Okay, now let me take theory by theory that you demolish. The first flaw that you point out is the concept of money multiplier. Now, how did we understand money multiplier back in the college days? If CRR, cash reserve ratio, is 4%, that is 4 by 100, money multiplier is ulta, it is 100 by 4, that is, it should be 25. Now, just for those who have not gone through the economics class that I went through, if you have a deposit of 100 rupees, the bank has to keep 4 rupees as cash. It can lend 96 rupees as a loan, which becomes somebody else's deposit. Then it takes out another 4 rupees, and then it lends 92, and so on. It can do 25 times. But you are saying it never works that way. Tell us how.
Yes, yeah, you very nicely explained how the concept of money multiplier works. This is one of the key multipliers in economics. There's also what we, for instance, call the consumption multiplier in macroeconomics, and you described it very well. It is a combination of deposit and loan transactions, in the economy that actually lead to the, to the multiplier. Now, as you rightly pointed out, monetary theory tells us that the multiplier is the reciprocal of the reserve ratio. Now, notice there is no other variable in this particular multiplier, just the reciprocal of the reserve ratio. What would that mean then? That if the reserve ratio is decreased, then the money multiplier should increase. If the reserve ratio is increased, then the money multiplier should decrease. And if the reserve ratio is flat, actually there should be no change in the money multiplier. Yet, when you look at the real world, take the global financial crisis. All through the global financial crisis period, almost 5 years, the Fed, for instance, the US Federal Reserve is the central bank for the United States, did not change the reserve ratio at all. And yet, during that period, the money multiplier in the United States declined from about 9 to 3. No change in the reserve ratio, and yet money multiplier goes from 9 to 3. In a similar way, if you look at in India, during the global financial crisis, the Reserve Bank decreased the money multiplier from 9% to 5%. So what would monetary theory tell us? That money multiplier should basically increase from about 11, which is reciprocal of 9%, to 20. And yet what you find was during that period, money multiplier was nowhere close to either 11 or 20. It ranged between 4 to 5. Even during the COVID crisis, similarly, the cash reserve ratio was decreased from 5% to 3%. Again, the money multiplier should have increased, but what actually happened was it decreased from 7 to 5. So clearly, this particular prediction of the monetary theory is completely at dissonance with what we observe in the real world.
Okay. So in that case, what should be the correct, or what is your theory of money multiplier?
So I think it's important to take a step back and ask the question, why is it that the theory of the money multiplier does not work? And that is where the framework that we develop becomes very important. Here it is really important to understand that the theory of financial intermediation, which underlies a lot of monetary theory, treats banks as financial intermediaries. It's like, thinking about them as basically they take deposits and then use those deposits to give loans. That is in some way like passing the parcel. Yes, monetary theory and financial intermediation does talk about liquidity transformation. So, banks take liquid deposits and converted them into illiquid assets. It's as if they take basically liquid milk, convert it into ice cream, but it's still passing the parcel is basically how the current theory thinks about. Now, actually, if you think about how it works in the real world, banks are money creators. They're creators of money. They're not just intermediaries. And let's understand this conceptually. For instance, if I were to borrow 1 lakh rupees from you, Lata, what you would do is basically you would write me a check. And your deposit would come down, my deposit would go up. It basically just passing the parcel. You pass the parcel of 1 lakh to me, it came from your hands to mine. That's the way it works when lending happens between individuals. But that is not how lending and deposit creation happens with banks. If I approach ICICI Bank for a 1 lakh loan, they look at my credit, and they decide to, let's say, sanction a loan. When they sanction the loan, what they're doing is they're actually depositing 1 lakh onto my bank account. So it is the approval and the sanction of a loan of 1 lakh that is increasing the deposit. So loans create deposits. And this is extremely critical. We actually use the demonetization in India as a natural experiment to provide rigorous evidence that it is not deposits that create loans, but actually it is loans that create deposits. We provide other evidence as well. So I think this is really critical to understand. In some sense, therefore, the Reserve Bank, which basically creates primarily the cash that we carry in our pockets, that's a currency in circulation, that accounts for only 15% of overall money supply in the economy. In contrast, banks, the deposits that they create, that accounts for 85% of money supply. And they are the money creators. And actually, including this year's Nobel Prize, the monetary theory gets this part wrong by treating banks as passing the parcel. They're actually creating money.
Okay, that's very important. It's not Lata's money that goes to Subramanian. When Subramanian takes a loan, bank creates a fresh deposit. So,
exactly.
The loan creates its own deposit. But,
Yes.
central banks also create money. When they buy dollars from the system, they are printing money. So, can you just explain that? Central banks also create money. Banks also create money. How does the two work?
So the technical term, that is used for the money that is controlled by the central bank is what is called the monetary base. While the overall money supply basically is the currency, in circulation plus the deposits. As I just mentioned, about 85% of money supply in the economy is created by banks. The central bank, of course, eventually, whether it comes through, through foreign currency or others, basically, it does increase money supply in the economy. But primarily, the control that the central bank has is on the monetary base. And the monetary theory tells us that the monetary base multiplied by that money multiplier is basically what is equal to money supply. Now, as I just explained, the money multiplier does not work. Conventional monetary theory is, it depends on the notion that by cutting the reserve ratio, the central bank can increase the money multiplier, thereby increase the money supply, or they can increase the monetary base itself, thereby increasing the base on which the multiplier works and increases the money supply. But in reality, what happens is these are basically two different. The central bank is creating the monetary base, controlling the monetary base, while the banking sector collectively is basically deciding the amount of deposits through the loans in the economy. And this is really important to understand. So effectively, it is the banking sector that is actually the biggest money creator. And current monetary theory gives far more power to the central bank than there is in reality. One more point to understand this, which is if you take cash. Cash basically is the demand that there is for cash in the economy. That is what the central bank creates. And as we will move more towards digital money, fintech, etc., that demand for currency will actually decline. In contrast, we take India in the banking sector. Just 1 in 7 people in India, citizens actually have a bank loan. So there is huge demand supply mismatch, and the supply, increasing that supply can increase money supply in the economy. In other words, the banking sector is an active money creator, while the central bank is basically a passive money creator because it is just catering to the demand for currency. Again, this is important to keep in mind when we think about actually monetary policy in the economy. Bottom line, what we are saying is we need to really focus on the banking sector because they are the primary creators of money in the economy. And the notion that the central bank can actually, really affect money supply through either the money multiplier or the monetary base is not right, because they're two, dancing to two different tunes.
Okay, we are trying to put the relevant portions of your book while you were talking. And from the book, of course, we have used the word M0 and M3. So just to explain to those of you who obviously haven't read the book, when Dr. Subramanian is speaking about monetary base, the central bank created money, that is M0, but the bank created money will be M3. The current monetary economics tries to relate the two and says that M3 is dependent on M0. What Dr. Subramanian is telling us, that it is actually an independent variable and it depends on the risk appetite of the banks and the borrowers. Okay, now
exactly. And just to add,
go ahead.
Just to add, Lata, this is, see, both of us worked as bankers before becoming academics. And one of the things that strikes us, anybody who's worked in a bank knows that the lending division basically just goes and lends, assesses the borrower's credit and goes and lends. It's not as if the lending division waits for the deposits to come from the those that basically bring the deposits. They are doing the decision on the lending, and importantly, as loans increase, basically, if the bank gives a loan of 1 lakh to me, it's creating an asset of the loan of 1 lakh is also simultaneously creating a deposit of 1 lakh, thereby increasing the balance sheet. And this is really critical to understand that banks are the biggest money creators in the economy. Just a small correction. M3 does include the part of the monetary base as well. But it's just that M0 and M3 are walking in completely different tunes. And it is, the banks that create the M3, primarily the money supply in the economy. So the power that we've given to the central bank, supposed power, is actually non-existent.
Okay, got that. Dr. Subramanian, we have to take a quick break, but there are other theories. I mean, after all, the central banks around the world have pushed in a lot of money into the system, as you point out. Why is that not getting lent? You correct our way of thinking about central bank created reserves and money supply. We will come to those questions in just a minute after this break. Welcome back. We've been discussing this path-breaking book by Dr. Subramanian and Dr. Vaidyanathan, both KV Subramanian and KV Vaidyanathan, called Money, the Zero-Sum Game, which is demolishing a lot of wrong understanding of monetary economics and monetary policy that both economists and observers belabor under. I've been speaking with Dr. Subramanian, one of the authors of this book. I guess all of you are familiar, former chief economic advisor. Okay, Dr. Subramanian, a lot of reserves are created by the banks. As you know, during COVID and during the global financial crisis, the central banks created these reserves, and people often, even journalists, ask, why are these reserves not lent by the banks as loans? Can you tell us why the two are related or not related?
Yeah, Lata, I think it's useful to just, for me, explain the three kinds of money that is there in any economy, just so that our viewers understand. One is currency, as we talked about. That is an IOU from the central bank to the public. Second is deposits. That is basically an IOU from the commercial banks to the public, also corporates. And third is what is called reserves. These are basically deposits, effectively deposits that banks keep with the central bank. So it is actually, an IOU from the central bank to the banks. Now, the notion that actually has prevailed and has led to a lot of unconventional monetary policy, especially after the global financial crisis, is that increasing the reserves in the banking system can actually enhance lending, the lending by the banks. And what we point out in the book that is actually not quite right, both conceptually and with evidence. And that is something that trend runs through everywhere. Yeah. We actually all predictions, we conceptually argue it and then provide very careful evidence for it as well. So let's understand conceptually. Now, this notion that reserves can actually substitute for loans should not depend on the number of banks in an economy, right? So just to understand, let's take the situation where suppose there are only two banks. For example, let's say I bank with State Bank of India and you bank with ICICI Bank. Now I basically approach ICICI Bank for a loan of 1 lakh. What does ICICI Bank do? It basically gives me that 1 lakh loan, credits it, to my account, and thereby my deposit goes up by 1 lakh. I write a check to you actually, and address it to Lata Venkatesh, and you go and deposit it in the State Bank of India. Now, when the Reserve Bank basically nets out, what does it do? It basically will decrease the reserves of ICICI, decrease the reserves of SBI, and increase the reserves of ICICI, because you are the one who's the recipient of that money. Now, this basically creates the optical illusion, because when you look at SBI, what has happened? I've gotten a loan, so SBI has given a loan of 1 lakh, but reserves have basically come down by 1 lakh, and that creates this optical illusion. How do we understand that? Let's look at the situation where suppose there is only one bank in the economy, just State Bank of India, right? Now, in this case, after having got that 1 lakh loan, if I write a check to you, you also have a bank account only with State Bank of India. That is I've just passed a parcel, from me to you. State Bank of India does not have to go to the Reserve Bank to actually settle this. In this case, there is actually no change in reserves at all. I think that clearly illustrates how the notion that reserves actually, substitute or, can create bank loans is an optical illusion. When you start thinking deeply about it, it basically is not correct. Now, look at the evidence. If you look at the global financial crisis, the reserves in the United States, for instance, increased from $15 million in December 2007 to about 2.5 billion in December 2013. So this is over a 6-year period. The reserves increased 170 times, 170 times. Now, what happened to bank loans? Bank loans actually declined, from 8 trillion to 7 trillion. So that tells you again, this is basically not working. Similarly, take India as well. You see India too, both during the global financial crisis and during the COVID crisis, the CRR was cut. That basically increased the reserves in the system. Firstly, reserves basically are not a constraint because there's huge excess reserves in the system. But, an increase during the global financial crisis for instance, from 1.2 lakh crores to about 8 lakh crores, almost a 7 times increase, had no impact on bank lending. It actually remained at about 5.1%, earlier, and 6.7% later. And if you would recall, the then finance minister, Pranab Mukherjee, actually kept lamenting, oh, we've cut CRR, banks are sitting on reserves, and yet they are not lending. And people also use this notion of lazy banking. What we point out is that whether it is about, this sort of ringing, finance minister ringing his fingers about banks not lending, sitting on reserves, or the concept of lazy banking is based on an incomplete or incorrect notion that stems from the financial theory of financial intermediation and the flawed monetary theory thereby.
We as journalists also belabored under that. Now things are much clearer. Okay, now there is another complaint which I often hear today in the market. Oh my God, loans are rising, but deposits are not growing as fast as loans. Now, what you are saying is that's nonsense. It's not a problem at all.
Yeah, well, I wouldn't use that word. Okay. I would just say that, I think conceptually we have to think about these correctly. So let me again point out here, as I as we discussed earlier, it is actually loans that create deposits, right? So let's understand this. The base of loans in the Indian system is about 120 lakh crore. Suppose there is a 5% increase in lending, that translates into 6 lakh crore. A 6 lakh crore increase in loans should be an identical increase of 6 lakh crores in the deposits, right? That is what we actually, loans create deposits. Now, the base of deposits, though, is 170 lakh crore. So an increase of 6 lakh crore on a base of 170 translates into only 3.5%. So just the fact that the base is much higher for deposits, clearly illustrates to you actually that, we're barking at the wrong tree, because a 6% or a 5% increase in loans actually translates into just a 3.5% increase in deposits. And more importantly, from a conceptual perspective, as we've shown clearly, is that it is loans that create deposits. This thought that deposits constrain loans is based on the theory of financial intermediation, which basically treats banks as just passing the parcel.
Okay. A final question, since we're running out of time. What is the advice then to central banks? When central banks find the economy has to be revived, all that they can do is to pump in more money supply, liquidity, so as to goad the banks sooner or later to lend because money is cheap. What other options do they have at all? They have to do this, right?
So I think that's a very good question. So as we've just discussed, banks are by far the most important entities for money creation in the economy. And whenever I talk about banking, I use the simile of an accelerator and a brake. The accelerator is basically the credit growth, and credit risk management is the brake. Now banks have to basically tune their accelerator and the brake very well. One of the key points that comes across in what can the central bank do? Central bank, as the banking sector regulator, can actually work both on banking sector regulation and supervision of the banking sector. So banking supervision and banking regulation, to make sure that the incentives are so that banks are basically tuning their accelerator and the brake very well. Especially, I will point out, banking supervision, for instance. If you look at the global financial crisis, or even the crisis that we had here in India, and you would recall in the 2020-21 economic survey, I had written a chapter that was basically on regulatory forbearance, where we had pointed out that, supervision was something that actually needed to be improved. So overall, one of the key messages for the central bank is to basically really focus on their role as banking sector regulators to make sure that money creation in the economy happens well. A specific suggestion that I would actually mention, especially in the Indian context, is if you take the capital requirements, and we know banks basically lever, right? For every 100 rupees that they lend, they actually keep about 9 rupees as equity capital. Now Basel requirements actually are for all countries only 8%. Now 8, when it's basically 8, the multiplier is about 12.5. When it is 9, it is 11.1. And you can see clearly, therefore, by enhancing the quality of banking supervision, which is why the cushion of 1% has been created. What central banks actually can do is to release and enhance the leverage, thereby enhance money creation in the economy, and thereby foster growth as well. I think the attempts that are made to actually either increase the monetary base or alter the money multiplier, thereby the money supply in the economy, I think we've pointed out those are basically things that are coming from flawed monetary theory and therefore are not working in practice.
Thank you very much, Dr. Krishnamurthy. That was an extremely enlightening half-hour lecture on monetary policy, and has corrected a lot of misconceptions that we have. And I hope this half-hour tempts you into reading what is a very important book that will change our thinking of monetary policy, Money, a Zero-Sum Game. Thank you very much, Dr. Krishnamurthy, and all the very best with this book.
Thank you very much, Lata.